Today, the U.S. stock market is a high-speed financial network grinding to a complete and total dead halt. Industrial heavyweights in the Dow are under pressure. The broader S&P 500 is showing weakness, and the tech-heavy Nasdaq is clearly hesitating. The world's biggest investors have stopped aggressive buying. The market is currently holding its breath at a dangerous crossroads, waiting for a major trigger to dictate its survival. The first domino in this chain is a sudden upward spike in global crude oil prices. High oil prices act as a direct catalyst for widespread economic inflation. When energy costs more, it increases the price of manufacturing and shipping. This threatens to reverse the progress made in cooling down consumer prices. Every additional dollar added to the price of a barrel of oil tightens the noose on Wall Street's growth expectations by forcing the government's hand. That pressure shifts to Washington, where rising inflation fears corner the Federal Reserve right as they make their next interest rate decision. While the rate itself may stay flat, investors are focused on Chairman Jerome Powell's tone regarding economic risks. If Powell takes a hawkish tone, meaning he prioritizes fighting inflation over cutting rates, it triggers a reaction in the debt markets. This moves bond yields, which act like financial gravity for stock prices. When these yields rise, corporate borrowing becomes significantly more expensive, and high-growth technology companies immediately lose their appeal. The Federal Reserve's fight against inflation creates a high-interest vice grip that transfers directly onto the balance sheets of Silicon Valley. Those balance sheets belong to companies like Microsoft, Amazon, Meta, and Alphabet, the tech giants that drove the recent market rally through artificial intelligence expectations. This chart shows the investment scale. On the left, massive capital expenditures are pouring into AI infrastructure. On the right, actual revenue generated from those products struggles to keep pace. If earnings disappoint while borrowing costs stay high, this becomes a massive, unsustainable bubble. Because these mega-cap stocks hold such a heavy weight in the index, a failure to prove AI profitability would pull the Nasdaq down with them. We can map out three possible outcomes. In timeline A, a bullish recovery, the Fed uses a soft tone. Tech earnings prove strong, and the Nasdaq pulls the whole market upward. In timeline B, a bearish breakdown, high oil triggers a hawkish Fed and AI earnings flop. This leads to massive profit selling and a severe market correction. Timeline C is a choppy market, where mixed signals trap stock prices in a sideways, volatile pattern. This sideways phase is often the most dangerous for retail traders. The market produces fake breakouts that trick people into buying, only to reverse and trigger their stop-loss orders without offering a real direction. The current market gridlock cannot last. Wall Street will be forced down one of these three paths in a matter of days. For short-term traders, the priority is waiting for market confirmation. Reacting to actual data is far safer than attempting to predict high volatility events. Long-term investors should avoid panic selling fundamentally strong companies, but they should also avoid buying into AI hype stocks that are already overvalued. The chain reaction is set. Oil dictates inflation, inflation corners the Fed, and the Fed determines if the AI bubble bursts. Which of the three timelines do you see playing out? Tell us your prediction in the comments below, and subscribe to Market Trap to track the result.